Banks are sitting on unrealized losses of over $500 billion. Hey, everybody, you're watching Bull, Boom, Bear, Bust. My name is JJ. We're back with another dose of economic reality. And this economic collapse, it is continuing and it is getting worse. The more news I dig up here, the more I realize that this collapse is accelerating even faster than I expected. And let's get into the first story here. We got a lot of news to cover. First, right here, the bond market crash leaves big banks with $650 billion in unrealized losses. Now, we saw some banks fail this year. We had a fifth bank fail just in the past few weeks. But think about this. You may think, oh, 650 billion, that's not that much. But let's put this into perspective, again, going back to the financial crisis. The financial crisis had a bailout program, a bank funding program that totaled about 700 billion. At that time, that was unprecedented. It was unheard of. It was outrageous that we had to have such a big bailout of the US financial system, and especially the big banks. But now we have banks underwater on unrealized losses on their bond portfolios by nearly that amount, $650 billion. So we're approaching financial crisis bailout numbers here in the amount that these banks are underwater. Also, bank stocks are getting plummeted. We're going to talk about that here in a few minutes. Some big bank stocks are down nearly 50% from their peak. And a lot of these investors that believed the talking points and they drank the Kool-Aid that the economy is recovering. Remember, since 2020, that's all we heard. The economy is recovering. The economy is recovering. People that believed that and sat in some of these bank stocks are down almost 50%. We're going to talk about which stocks here in just a few minutes. But first, into these numbers here. This was reported by Markets Insider and a few other outlets here. It's a sign even Wall Street's best known names are feeling the heat from the Treasury market rout. Again, all this debt, all these loans that were bundled up at rock bottom interest rates are now worth half and sometimes even less of what they were worth when they were issued. Now, the banks are choosing to hold onto these bonds right now in hope of a recovery. And what would a recovery look like? Well, it would be the Fed cutting rates, emergency rate cuts. So the banks are holding on for that. And we'll see, if that comes to fruition here. So now there's a lot of people out there saying that rate cuts are not going to happen because inflation has not been tamed. But remember, it's not about reality. It's about the Fed's reality. Remember, the Fed, they're out there saying that they're winning the war against inflation, the economy's strong, that we've made progress against inflation, but no progress has actually been made. Anytime prices are still going higher, then there's no progress, right? So prices were too high. The goal should have been to bring prices down or have deflation, but no, that wasn't the goal. The goal was to bring the rate of increase down. So the level of increase has slowed, but we're not seeing deflation. We're not seeing the cost of living coming down, and that's a huge problem with the U.S. consumer. Just in our previous report, we talked about how credit card debt could likely be the pin that gets pulled on this economy, or this plug that gets pulled on the economy, or the pin that pops the balloon. So, folks, it's getting close. And could the emergency rate cut reason be maybe one of these big mega banks failing, or maybe several of these mega banks failing? What do you think about that? Could that be the reason for the emergency rate cuts? And you think inflation's bad now, folks. If we get rate cuts or even the hint of rate cuts, you're going to see the cost of living take off like you've never seen before. And that's going to be a pretty scary thing if that happens. I would rather see a deflationary correction or collapse in the cost of living and asset prices versus what's going to happen if rate cuts occur and the inflation. It's going to be astronomical. It's going to be really, really bad. So let's just hope that doesn't happen. Let's hope the reason doesn't pop up here for that to happen. Let's talk about this whole, and you want an example here or two or three of how people are not doing so good right now in this economy. Remember, the consumer's strong and resilient, but here's a headline here. Recent headline: 401k hardship withdrawals are surging as high inflation squeezes Americans. So I guess a record number of people taking out 401k withdrawals is a sign of a resilient consumer. That's what we've heard over the past, couple years. The consumer's strong, the consumer's resilient. So why are we seeing this surging demand for emergency or what's called hardship withdrawals from people's 401k? And you have to pay a little hefty amount to Uncle Sam on this. So this is not something that people can just do without a penalty. So this should be taken, I think, kind of seriously. A growing number of Americans are making emergency withdrawals from their 401k retirement plans to cover financial emergency amid chronically high inflation. Yes, of course. And that's according to data out of Bank of America. We're going to talk about Bank of America here again in a few minutes. Over 18,000 workers took part in employer-sponsored 401k plans and made hardship withdrawals during the third quarter of this year, 2023. How much of an increase is that, though? That's up 27% just since the beginning of the year. So in less than a year, this has surged 27%, right? So if inflation was really just 2 or 3%, like we're being told, with 3.7 was the last one, I think we're still waiting for the October number. Why are the emergency withdrawals increasing by 27% since the beginning of the year? What's it going to be by the middle of next year? Is it going to be doubling or tripling of the number of people taking out emergency withdrawals out of their 401k? Hardship withdrawals allow workers to tap their 401ks for an immediate and heavy financial need. So it's not just, oh, I need to go buy something. You have to present the case to your 401k provider, and they have to agree to it and say, yes, that meets our definition of a dire financial need or a financial hardship. So even with the kind of the hurdles or obstacles in being able to just withdraw money out of your 401k, that many people still did it in the quarter, 18,000. It may not seem like a lot, but when you look at the size of the labor force here, which is almost 100 million people out of the labor force right now, that's a lot of people, and that's just one quarter. When we get the year-end totals, it could be 100,000. We'll have to wait and see, of course. But that's definitely something very interesting to keep an eye on here with this economic collapse. Now, let's talk about how this is affecting bank stocks. Here's some data to think about here. U.S. bank stocks hit all-time low relative to the S&P 500. So when you look at the indexes, they're not getting that beat up. They're down significantly from their all-time highs at the end of 2021, early 2022 for most of these indexes. That was the all-time high. We haven't surpassed that. We're still down a bit from that. But when you look at these bank stocks relative to the S&P 500, they're at an all-time low, Let's talk about Bank of America. That's just the first one I had pulled up here for this video. And when we look at the peak Bank of America, let's see, January 14th, 2022, just under $50. At the end of October, Bank of America stock, ticker symbol BAC, it was down to $25.17, folks. That's about a 50% haircut from the peak. And it did jump back up a little bit here. It's about $28, just under $28 as I read this. Of course, the market's closed as I'm recording this, but you get the idea. This is a big, big plunge. And imagine how many employees at the bank, like a lot of people take out their own company's stock or invest in their company's stock. Imagine these employees down nearly 50% on their retirement accounts, and at the same time taking out emergency withdrawals for hardships. And you kind of get the picture, I think, what's going on with the economy right now and most U.S. consumers who, even before all this mess started unfolding, most people were living paycheck to paycheck. But that's the new normal now. So that's why people really hear this and they think, oh, he's exaggerating. He's making a mountain out of a molehill. It's clickbait, stuff like that, because people have accepted just living paycheck to paycheck and being in debt for life. They've accepted that as the new normal. But I like to look at, history and see how much worse it's gotten just over the past few decades. You can see, people in the 70s, 80s, even the 90s could get by on one income. You could buy a home on one income. Now, close to half of the youth in this country is living at home. I've got a recent report here on that. Let me just pull that up real quick. Bloomberg, nearly half of all young adults live at home with mom and dad. And we have this supposed housing shortage, even with nearly half of adults, or nearly half of young adults living at home. How much worse would the housing shortage be if these people were to go out and try to pay rent somewhere? It would be even worse. Well, speaking of rents, rents are dropping. There's been some news on that. Apartment List is reporting that rents have dropped now for 3 months in a row. Quote, for the third consecutive month, rents have fallen nationally, illustrating the growing impact of supply outstripping demand over the last 8 quarters, said Jay Liebig, National Director of Multifamily Analytics at the CoStar Group. Quote, all regions saw rents fall in October, but markets in the West and South experienced the steepest losses, unquote. All right, so what do we think about that? This is really starting to heat up and melt down, whatever term you want to put on this here. Rents falling, consumers struggling, taking money out of their 401k. The savings rates plunged again. We talked about that, 2 videos ago. So I don't see this lasting too much longer before something has to give. And what's it going to look like? I don't think anybody knows, because we're in unprecedented territory right now. When you look at the amounts of debt, we're so much worse than we were back in the financial crisis. And back then, people called that a financial crisis. We look back at it today, it's still called the Great Financial Crisis, the GFC, as many people call it. But everything's much, much worse today, and people are more highly leveraged. The government's way into deep into debt right now to ever even think about paying it off. It's impossible, just mathematically impossible to pay it off. So something's got to give. What's going to happen? Well, let me look into my crystal ball here for this. Got a crystal ball. Let me see here. Mr. Crystal Ball, economic crystal ball that engulfs the whole galaxy. Can you see the galaxy in there? What are we going to see in 2024? Will we see emergency rate cuts? Jerome Powell, are you in there? Emergency rate cuts. What's going to trigger the emergency rate cuts? Is it going to be the entire banking system goes down and goes dark and no one can get their money? Because the U.S., we're creating enemies across the globe by picking sides in wars and conflicts and funding one side. So therefore, the other side is very hostile to America. Could that be? Could we be victims of a big financial system hack, which takes down the entire financial system, and therefore everything goes dark, and we're going to see Mad Max in just maybe 72 hours after that happens, maybe even sooner? I'll let you guys know. Thanks everybody for watching. Big love. Keep stacking. We'll see you back here on this channel again, I hope, if you're nice enough to come back and see what the crystal ball says next time. Thanks everybody.